this is Eve. My group mates Aaron and Kiera and we conducted a research on the exchange rate of Australian dollars to US dollars and the US dollars to Japanese yen. So here's the graph from Forex Capital Trading. It's here to give you an overall idea of Australian dollars and US dollars for the past few months. As you can see, Australian dollars has been depreciating against US dollar, that it even peaked at 0.80 due to the broad-based depreciation of the America. So to forecast the upcoming trend, we are going to conduct a fundamental analysis using 4 indicators, with the first one being the relative interest rates. So as you can see, the target federal fund rate is set at 1 to 1.25%, and the cash rate of Australia is set at 1.5%. As you can see from the data of the Federal Reserve Bank and also the Reserve Bank of Australia, they are trying to have a lower nominal interest rate to strengthen the labour market and to attain a sustained 2% inflation. This graph here from the ABS shows the relationship between the nominal interest rates and cash rate. And so in a traditional point of view, country with high interest rates tends to be more attractive to foreign investors, which increases the demand of the dollar and also the current relative value of the currency. Since Australia has the high interest rate, it should be more attractive to foreign investors. However, the US launched the balance sheet normalization program, which is to be commenced in October, to gradually reduce the Federal Reserve's 4.5 trillion portfolio of securities holdings. So what it means is that the money supply in the market is going to be decreased by a great deal. So with the decrease in money supply, it moves the LM curve upward. As you can see, the real interest rate is increased due to the program. Real and nominal interest rates being increased, there will be less capital outflow and therefore less supply of the US dollars. At the same time, the high interest rates will attract foreign investors to increase the capital inflow and therefore greater demand for the US dollars. So you can see that the exchange rates of the US dollars increase, the relative value increased, so the Australian dollars depreciates against US dollars. The third indicator would be relative economic growth. As you can see in a chart provided by the US Bureau of Economic Analysis, the US economy is recovering from the softer economic activities due to the smaller consumer confidence before and the decreasing and the decelerating non-residential investment in the late 2015 and the early 2016, with a growth rate around 2.3%. From the data of the Federal Reserve System, there was a 3% increase in real GDP. The increase was mainly due to an increase in private inventory investment, federal government spending, and the private consumption expenditure, which were partly offset by negative contributions from residential fixed investment, state and local government spending, and more importantly, a deceleration in net exports as imports increased. It can be related to the increased private consumption expenditure as well. At the same quarter, the real gross domestic income increased 2.9%, which explained the acceleration in private consumption expenditures and imports. With more imports, the supply of US dollars increased, the US dollar depreciated. It can be one of the explanation of the depreciation of the US dollars recently. While at the same time, a stronger economic growth can lead to more overseas borrowing to finance investment. The net effect is unknown though.
Hi, I'm Kiera and I'll be continuing the presentation from Eve. Economic growth in Australia has been positive for the last 26 years. This is the longest period an economy has had positive growth. This is due to fiscal policy and economic stimulus packages, in addition to the reduction in interest rates by the RBA. In this graph here, it shows that Australia has positive growth that is stable. However, the growth rate is too slow to catch up to an interest rate hike and the household debts. Australia's economic growth rate is lower than the US and the rest of the advanced economies. While a number of advanced economies' monetary policies are expected to go less accommodating as anticipated, Australia can't really afford that. Australia's current and future consumption ability is restrained by the weak wage growth and the high debts to disposable income ratio. while the consumption ability of the US is accelerating with higher GDI, and the US is going to implement less accommodative monetary policy. Therefore, Australia is likely to depreciate against the USD. According to the data from the Federal Reserve Bank of St. Louis, the inflation rate has overall decelerating rate, running below the target of 2%. It is said by the Reserve Bank that this may be caused by higher gasoline prices and natural disasters. As shown here, the projections show that the interest rate is going to fall from 1.7 to 1.5 and 2.2% to 1.9 in 2018. This matches the expected result of a hike in interest rates in the coming quarter, or the balance sheet normalisation program. Looking at the comparison graph shown, we can see that Australia's inflation rate is ahead of the changes compared to America. This is because Australia is more sensitive to market changes, and hence the USA is more stable. As seen on the graph, inflation rate in Australia and the USA dropped dramatically in 2009. This was due to the GFC. The US projected inflation rate at 1.5%. There is a high possibility of an interest hike in the coming quarter. This is due to the balance sheet normalisation program. Australia's inflation rate is 1.9% in the last quarter, strengthening employment and record low cash rate at 1.5 to entice economic activities. Therefore, the Australian dollar is likely to depreciate. This is a forecast for the Australian dollar and US dollar exchange rate. The National Australian Bank predicts that the exchange rate will worsen from its current rate of 0.9%. This makes sense given that the inflation and economic growth is slow.
Hi there, my name is Aaron and I'm here to continue the presentation on USD and the JPY exchange rate. As seen here, the USD has been appreciating against the JPY. Now, these are the factors that we'll be looking into that affect the exchange rate of the USD JPY. According right here to the graph, the interest rate of the US, the target range for the federal funds rate is set at between 1 to 1.25%. And the interest rate of Japan is currently at negative 0.1% from an original rate of 0.1%. The BOJ has set the rate at 0.1% to increase spending and investment in the economy. Now, Japan has been trying so hard to boost its economy that the BOJ adopted qualitative and quantitative easing in 2013. Yet they were insufficient to attain the expected growth rate in the economy. The Bank of Japan voted in January 2016 to nudge the interest rates down from an already 0.1% to a negative 0.1%. As seen here, the economic growth rate of the US is recovering from a slump. Overall, its growth rate is higher than Japan at around 2 to 3%. Now, the economic growth rate of Japan is comparatively lower than that of the US and is at 0.5%. As you can see here, Japan's economic growth rate is very unstable, so this is not beneficial for the economy. Now, basically, the economic growth of Japan in the last 40 years has been seen to have been slowly declining, as you can see here, and is especially prevalent in the GFC in 2009, where you can see a huge spike right here that Japan had a huge negative growth rate, and it could not attract enough consumers to spend and invest in the economy. Now, this graph here, extracted from the World Bank, demonstrates that the economic growth in Japan is not catching up to that of the US. According to the data of the inflation of the Federal Reserve Bank of St. Louis, beginning from the first quarter of 2017, the inflation rate has overall been in a decelerating scale. As you can see here, running below the targeted 2% inflation rate. According to the data from the Bank of Japan, beginning in the first quarter of 2017, the inflation rate has had a slight rise, but is still running below the target of Japan of 2%. Japan's economy has been facing deflation in the past, and in order to prevent this, the Bank of Japan has lowered the interest rate to a negative rate to prevent the economy from sliding back into deflation. Now, looking at the comparative graph shown, we can see that the US inflation rate is ahead in changes compared to Japan. This is because US is more sensitive to market changes. Hence, USA is slightly more stable than Japan. Now, in conclusion, the US, because of their possible interest rate hike, this would draw foreign investment into the US and would boost the demand for US currency. While Japan's economy still doing okay, it cannot compare with that of the US economy. Now, forecast for USD JPY rate in next June 19, it is forecasted to be 1 USD to 120 yen.
So if you're trading forex, you are recommended, based on our research, to sell AUD to USD and buy in USD to JPY. Thanks for watching.